Big tech and the internet have permeated almost every aspect of our personal and working lives. This has put them in a position to know a lot about us, information which they can exploit to grow their businesses and profits. With so much soft power in the hands of big tech, there is a global movement to keep them in check, from the US to the European Union and most recently, mainland China. Last October, Beijing released a draft personal data protection law. It followed up in November with draft rules to stop monopolistic practices in the internet industry.
China has been lagging in the sense of the regulations on the tech space. In the past, its primary focus is to improve the efficiency rather than the fair competition. However, this could potentially crowd out some of the smaller companies and potentially hinder the innovations. And this is what's happening right now. The regulation aims to create a more level playing field for everyone in this industry and to ensure the long-term sustainable growth for the industry.
Observers don't think the bottom lines of major internet platforms like Alibaba, Tencent, JD.com, Pinduoduo and Meituan will take too big a hit.
Baba has, I think, over a 60% market share in the e-commerce space at the moment in China. Baba's market share could still come down to 30+%. It's still a very good business. It's still going to generate really strong returns for its shareholders.
Mainland China's domestic market continues to present huge opportunities for all players, big and small.
1/3 of the population, which is higher than the entire population of the United States, still not online. And China has the rising middle income class, which is, again, world's largest.
Consumer spending in China is going to be one of the key drivers of China's economic growth over the next decade and more.
And the pie is set to get bigger as enterprises go online.
We can see that when a lot of the small enterprises moving online, they want to have a better connection with their own customers, own consumers, and that would create more opportunities for the B2B side for the internet space.
But could US-China tensions derail the growth trajectory for the Chinese internet players? Former US President Donald Trump had signed an executive order barring US transactions with 8 Chinese software apps, including Ant's Alipay and Tencent's WeChat Pay.
The internet space, we have seen this affecting those big tech companies' expansion into the overseas market. On the other hand, the access to the US capital market could also be in trouble for those big tech companies. But we think that the domestic market liberalization is somewhat mitigating such a risk.
For now, investors are looking past the tensions and focusing on the growth potential of the sector instead. One index which tracks the performance of some of the largest Chinese tech companies is the Hang Seng Tech Index. Some well-known Chinese names, including Meituan, Tencent, Alibaba, and JD.com, have a weightage of between 6.77% and 8.04% in the index. The Hang Seng Tech Index is up 17.3% so far this year, versus 10% for the Hang Seng Index. Looking at the one-year returns, the strong performance of the Hang Seng Tech Index is even more obvious. The index generated a one-year return of 86.45%.
The performance difference will be leveled down in coming 1 to 2 years. But for long term, we expect a relatively healthy earning growth for Chinese tech stocks. So if you buy it at reasonable valuations, I still think that you can enjoy a handsome profit in mid to long term.
As tech stocks correct, investors will have to brace for volatility.
Investing in big tech obviously is a high valuation, high returns, also high volatility, and together with that also a little bit of risk as well. So I think if you were going to buy into technology stock, you have to be prepared that there will be volatility versus perhaps a cyclical or a defensive source.
If an investor can't stomach the rise and falls, he may want to consider investing in an ETF which tracks this index.
Average individual stocks, so the volatility it is 59%. Yeah, but if you invest in the index itself, the volatility is 38%. So you will see invest on the ETF, it is the way to reduce your risk exposure.
The ETF reduces risk exposure by mitigating the company's specific risks. There are a number of exchange-traded funds in Hong Kong which track the Hang Seng Tech Index. They include the iShares Hang Seng Tech ETF and the Hang Seng Tech Index ETF by Hang Seng Investment. In Singapore, the Lion OCBC Securities Hang Seng Tech ETF offers investors that same exposure to Chinese tech. However, with the tech sector looking pricey, some analysts don't recommend buying into a tech ETF. They prefer to do active stock picking to uncover investment opportunities.